All right, all right. We are live. I am alive. Everything's fine. Everything's going to be fine. Boy, oh boy. If you are a fan of volatility, you're having a good time right now. If you are a fan of low interest rates, you're not having such a good time. Mortgage-backed securities are down 150 plus basis points on the day. For those of you who are like, what in the world does 150 basis points mean? 1.5% or 1.5 points on a $400,000 loan is $6,000 in cost. So if you had a rate on Friday, let's call that rate 6.875, or probably better than that even. Maybe that rate was 6.5. That had whatever cost it had associated with it, 0, 2,000. It cost you $6,000 more for that rate. Or if you're just looking at what rate you could get without any cost, rates are probably up 3/8 to 0.5% in rate. Now that's crazy. A lot of lenders without paying points are going to have 30-year fix for their most eligible borrowers on an owner-occupied residence in the 7s. I know for fact that nobody, and I mean nobody, forecasted this at the beginning of the year. You know, all the rate forecasts that are like, could rates get to 4%? Could they go all the way up to 4.25%? We're going to see. Nobody was forecasting even sniffing 6 or sniffing 7. Yet here we are. So I think the more important thing to consider or talk about is, how is this going to affect real estate? How is this going to affect real estate prices? How is this going to affect buyers, which is the most important thing to me in my mortgage business, my team, my clients, 100 plus people pre-approved in different stages, you know, either looking to buy, submitting offers, maybe some are holding off. How do you go about strategizing to get yourself into the best mortgage? And here's where I had this conversation with my team earlier today. Now more than ever, great agent, great mortgage professional working together in tandem. I'm trying to get on more Zooms for my local stuff with client and realtor alike and say, let's figure out what the monthly payment target is. Let's figure out what fits into your budget. Let's structure your offer around that. Because the good news is sellers in many markets, for sure in Sacramento, are open to negotiation. With that door open, we can do stuff like a video I put out. I recorded it last week. It's not out till tomorrow. Tomorrow I put out a video that illustrates this. 525 purchase price, sellers willing to negotiate. We don't know whether they're going to come down 5,000, 10,000, 15,000, but just for example's sake, if you put $510,000 purchase and you say to yourself, you can get it in contract for 510, that mortgage payment, if my memory serves me correct, with 10% down, without buying the rate down, is something like $3,700 a month. And forgive me if I'm wrong, I'm just going off of memory. I know for sure that if you kept the price at $525, you took $15,000 in seller credit, and you used that $15,000 to buy the rate down, it was going to buy the rate down in the scenario that I looked at a full percentage point, saving the client $200 a month. They're paying $525 for the house, and they're taking $15,000 in credit. Same net to the seller, as if the seller sold it for $510 and got the credit. Good news is, in some markets you can get both, right? So you might do even better. You might get $510 and the seller credit. But even if you couldn't, if you could get one or the other, $15,000 in price reduction or $15,000 in credit, it's a $200 a month difference to the buyer, to the payment. So those are the kind of things you want to do, because the buyer, if you're holding this thing for the long term, 10 years, 20 years, 30 years, Are you going to look back and say, I wish I would have paid 510 instead of 525? Or are you going to worry about what is the most important thing in 99.9% of people's lives? Their monthly budget, right? $200 a month. While I'd love to say is not the make or break, for some people it is, especially when you're scraping the top of your budget. So look out for that video tomorrow. That video, I think, is important. That video is something that I'm going to point agents towards because I think that it's that important. I wish I had a copy of what I did on Thursday or Friday when I recorded this, because I think it's valuable. And here's what I'll do. I'm going to do some quick pricing so I can just show you guys a real example. I think this is important. 699. Okay. 1 point, 2 point, 3 point. I just want to kind of stress the importance of rate and how it affects monthly payment. And then we'll talk about the market. We'll talk about how much these interest rate increases are going to affect sellers, because sellers are going to be in for a world of hurt. They don't know it yet. If you know a seller, let them know. Let them know that, hey, if you weren't getting any action at 525 on your house, rest assured, when buyers start running scenarios based on a 0.5% higher interest rate, you ain't going to get no action. You might want to strongly consider going to 479 today. Even if you could probably get 500, don't try to catch a falling knife and try to chase it down. Make the adjustment today as affordability becomes more of an issue, as interest rates go up and buyers continue to lose purchasing power literally day in and day out. You cannot afford. Oh, you can't hear me clearly? Well, that's sucky. Let me know if anybody else having trouble with the sound. MSM 41009. Thanks for that. Let me know. Mic check, mic check. If I can adjust some volume controls here. I might have turned that down. Noise? Okay. Shoot. It's an important day in rates. Better? I unplugged that, plugged it back in, turned my fan off. Are we better? All right, cool. Maybe it's that fan. That's funny how that fan caused that problem. Okay. What'd you guys miss? Rates? Did they go up? Here's what I'm going to do. I'm going to put up, I appreciate somebody saying something, because I'd hate to do this whole thing. I know how nasty it is to listen to something. You're like, man, I'd like to listen to this. It's probably going to be a good conversation, but you know, the hearing it is just tough. Okay, let's share screen. Let me see if this is legible. Sometimes it's hard to read, but this Excel spreadsheet, if you guys can see this, it's basically 525 with 10% down and, you know, 675 interest rate, which may be, you know, next to no cost if you've got great credit. 3777 payment. if you can get seller credit or you want to buy it down, it's probably going to cost you up to 3 points. So you might need like 14 or 15,000 in credit to get here, but 35, 45, $230 a month in savings. Like I said, too, what you might be able to do is negotiate credit and a price reduction. But just for example's sake, just to show you what I was talking about earlier, if you got this one on the right, 5.99, and it cost you 15K to get there, and the seller pays that 15K. If you just said, oh, instead I'll just pay 5.10 and I'll just keep the 6.75 rate, $36.69. You're paying an extra $124 a month with the same net to the seller. So if the seller gets the same, they don't care whether it's here or here. You want to structure it a way that works best for you, which is higher price, credit to buy down your rate. That's why these conversations around bad mic again. This is terrible. Okay. Mic check, mic check. I got it unplugged and plugged back in. That's about as far as my tech can take me. Come on. Do rates have gone so bonkers that my mic is out? Come on. Tell me she's fixed. Tell me it sounds beautiful. Uh-oh, I better not mess with it no more. Is it good? Thumbs up. There's like no sound in my office. Lights are off. Fans off. Are we good? All right. I'm gonna move slow so we don't have any issues. Not sure if this rate stuff was missed, but if you did miss this, tomorrow, 2 p.m., the video comes out just showing you structuring and how buying down the interest rate is going to do much more for your monthly payment. Another video I'm going to make is a new rate buy down product that I think makes sense. If you've been following me for any length of time, you know that if it doesn't make sense, I'm the first one to say. If it makes sense, I'm also the first one to say. And I spoke out about the 2-1 buy down, 3-2-1 buy down, not being really something I was a fan of because it got you used to paying a lower interest rate. What I see of these new products coming along, which is really, really cool, the lender's still getting their interest. So if you have current rates in the high sixes, call it 6.75, and the 2-1 buy down will give you a 4.75 year one, a 5.75 year two, and then it goes 6.75 for the years on. The cool part about the newest programs is one, the seller pays it and they just prepay that interest, right? Whether it's 10, 12, 14,000 that you're saving, depending on loan size, it gets paid up front. You save that money on your mortgage payment. And while I want to, caution people to don't get used to the smaller payment and let your lifestyle inflate into that extra money, put that money to the side. If you refinance within that first couple of years and that money isn't spent, meaning you paid the interest up front, the seller did, and you didn't get to realize it because you refinance, because inflation gets under control and rates come down, you get that money applied towards principal. So you don't lose it. That to me makes that a winner. So anyhow, that's my 2 cents. Let me see if we got any questions on here. And sorry about the sound issues. I'll figure this out. I'm really, really scared that I had audio issues. I recorded 2 podcasts earlier. If you haven't checked out Get Better Every Day podcast, please do. I'll put a link up to that because it's really a fun passion project. Had a really great conversation with the 2 guests that I talked to today that obviously will be on future podcasts every Friday on Apple Podcasts and Spotify. You'll find those. I'm posting it in the comments, the link to Apple Podcasts. If you're a Spotify user, find it on Spotify as well. I'll share that one. Okay, let me get to some comments. I appreciate you guys being here. I love to have some conversation. I know some of you have different thoughts. What's up, Kevin? Thanks for joining from Lakeland, Florida. Appreciate you, brother. Appreciate the constant support. Eccentric, it's over for real estate. We're going to see 10% mortgage interest rates. I put a lot of money on the fact we wouldn't see 8%. My bet is looking bad because for certain borrowers, lower down, lower FICO, it's sure looking like 8% is in our sights, right? So I'd love to hear your take, Eccentric, because I'll be the first to admit I don't know it all. Not all my predictions always come true. I'm just telling it how I see it, but I did go from seeing flatness in 2023 to see a 5 or 10% price correction. What people have to take in mind is if you pass on something today at 500 and you have the ability to buy it down to 5.99% and you get a great deal because it goes down 8% and you're able to buy it for 460 in 3 months, know that if you buy it at 460 with an 8% interest rate versus 500 and a 6% interest rate, you're much worse off. And there's no need to guess because I have this Excel spreadsheet in front of me. I will do the math because that's the kind of friend I am. 500,000. I like using 10% down lately because average first-time home buyer is 7. Some do 3, some do 5, some do 10. A lot of people do 20 and 25. Those are, usually buyers who are on their second or third home or, have money from an inheritance or whatnot. Not everybody can just save up those larger down payments, especially with home prices like they are in California. So 10% down, $500,000 purchase. You get some seller concessions and you get 5.99. Your all-in payment, taxes, insurance, mortgage insurance, principal and interest, $33.76. Homes go on sale. Let's say homes go on sale 10% cheaper. Same house, $450,000, but rates are higher, and those higher rates have drove down prices, sustained higher rates. 8%. Now you're looking at $35.83. So if I would have wrote down my first number, I would know what the difference is. $35.83 and 500 at 5,999, $33.76. Yeah. So you got the house for 10% discount, but you pay $200 more per month. I know because I talk to clients all day, every single day. Monthly payment is the number one driver. It's what fits into their budget. It's the most important thing. So that's my take on that. Danny Fox, good question. We've seen some nasty days in mortgage. I can't remember 155 basis point drop like today. Pretty nasty. But for sure have seen close. I think we've definitely seen some 130s, 140s. I remember I was brand new to mortgage and there was the taper tantrum of, I believe, 2013. I don't even know if he even had my license yet. But it was pretty gnarly. 155 basis points down on mortgage-backed securities. The 10-year is up 23 basis points to 3.92. That is absolutely bonkers. And you're going to see, Mortgage News Daily, which I point to a lot, 6.87 is their average 30-year rate. That's going to go above 7 tomorrow. I guarantee it. National average of, all lenders. Whew. That is gnarly. It seems like years ago, early August, we dipped below 5%. Early August, we saw some 4.99s and 4.875s. All right, Black Nurse 7. This is an amazing question, a really popular question. The maximum amount you can buy down the interest rate. Usually, to pass what they call QM, to be a qualified mortgage, the lender's not going to allow you to charge more than 3 points. And from what I'm seeing on a lot of rate sheets, 3 points is about 5.99. And that's on a very well qualified client with great credit. So yeah, even if my rate sheet takes me all the way, which it does, to whatever the heck the top of the rate sheet is, 4%, if it costs 6 or 7 points, you can't do it. The mortgage won't pass QM. All right. Everyone's saying better. Sound is good. Mic good. Sound better. All right. Whew. As I scroll through the comments, I'm like, please tell me. You know what I'm going to do, Andre Green? Because Jeb's a great dude, a great real estate agent. I am going to see if he wants to do a live. Maybe he wants to jump on with me next week and talk about it. Because I don't see housing just crumbling. I don't see home prices going down 30, 40%. So I'm not a crasher. I'm also not things go up forever. And even a couple months ago, I was on the flatline train saying 2023 would just be flat. I am now, because I see in my own business how much demand has just been sucked out. And literally the Fed said that. We are going to quell demand. We're going to take demand out of the market by raising interest rates. They done did it. All right, Eccentric, you call your shot, bro. How much? How much is housing going to crash? Why? Give your reasons. Because I'm a man who likes to listen to it all. G Glover, what are investors' interest rates? 760 FICO. I'm happy to do this stuff. This is valuable in my opinion for anybody, just because I'm not going to sugarcoat. I'm just going to give you the real deal Holyfield. All right. I'm going to price it raw. Is my internet lagging? I'll price this for you. I like to go, realize the more details you give, the closer I can get with giving you a real scenario. But I'm going to go like $400,000 purchase. Because keep in mind, you buy something for $130,000 with 20% down or 25% down, it's more expensive because lenders can't make any margin with this is a good point, Eccentric, that people should hear. People that have low interest rates, if they are forced to sell, some of them will, I agree with you there, will not understand what an asset that low interest rate is. I had a buyer call me today, and she said, should we sell our house? And I think she has a 2.625 30-year fixed. I said, avoid selling that house at all costs. I think she's got a $2,100 mortgage payment and could rent it for $3,000 only because of that low interest rate. If she was sitting in a 6% interest rate and her mortgage payment was $3,400, she could sell it, take the $150,000 in net proceeds after the sale, and do whatever she wants. But because of the fact that she's got that low interest rate, that is for sure an asset. Eccentric, if we don't agree on other stuff, I agree with you 1,000% that sub 4% mortgage rates on a 30-year fixed is a huge asset. You would have to pry those notes from my cold, dead hands to get me to give up any of those. They're that good. All right. I was afraid of this, G Glover, that you're going to tell me some low purchase price, like 120K. Because if I priced it with 25% down and it was 400K purchase, the rate would be infinity better than what I'm going to price 120,000 with 20% down. You won't get some lenders to even do this. If it's minus, or if it's less than 125,000 loan amount, you know what I got to do? I got to price it at multiple lenders because not all lenders want this. Sometimes on these lower loan amounts, you might be better going to a local credit union. That's the kind of advice you're going to get subscribing to Matt the Mortgage Guy. I'm not always going to tell you we're the best option. Sub $75,000 loan amounts, I'm going to tell you for sure. This one, $96,000 loan, you probably get your best deal in the broker channel. But $50,000 loans, $60,000 loans, you're going to want to establish a good relationship with a local credit union, especially if you're going to be doing investments. You want to buy, 10 of these properties in these markets that are more affordable. Where are you buying something for 120, G Glover? All right, purchase, investment, single family. I'm guessing 20% down. You get a better deal putting 25% down, but at this interest rate, I'll be honest with you, rate isn't a huge factor. It's not nearly the same importance that it is when you're borrowing $500,000. I can promise you that. Borrowing 96 when you're buying for 120. Holy moly. Yeah, see, lenders don't want this stuff so bad that they're literally charging 6 points. Could I even get that thing to qualify? I'm showing 6 points to get a 7.6% interest rate. Holy. $7 points at another lender. All right, let me try something new for you, G Glover. As suspected, lenders are not lining up to write $96,000 loans. I'm going to go 25% down. Eccentric, 120 is not a trailer in California. It's a parking spot. But as an investment, if you get something that, this cheap that'll rent for $800 a month, more power to you. I know a lot of folks that are crushing it in Memphis, Tennessee. Even 25% down, you got to pay pert near 6 points. But the rates, funny part about it is the rates are in the 7s still, but there's just a lot of points attached to it. All right, what other questions we got? Fire off the questions. I want to hear from other loan originators. I want to hear from real estate agents. I want to hear from people that think the market is crashing, like my boy Eccentric. 20%. All right. I mean, 20% isn't crash. Like, this is dramatic, bro. This is like 40%. You just say the market is going to have a pretty big adjustment, a pretty big correction. because that's what 20% means. If we corrected by 20%, I would not be surprised. If rates continue to rise and stay elevated for an extended period of time, prices, in my opinion, will correct. Be careful. Where'd it go? My boy, AJ. Be careful with comments like it cannot stay high for long, because just because we don't want it, or it might be painful for borrowers, the housing market, and the economy, doesn't mean it can't happen. I mean, I think that the talk track coming from the Fed is we will keep them high. We will do it higher, longer than most think, if it's necessary to get inflation back down to 2%. What I think is likely to happen, and why they won't stay as elevated for as long as some people might think, is per that conversation I had with Barry Habib, looking at the month-over-month inflation numbers, looking at core inflation specifically, October, November, December readings last year were super high. If we have any control over inflation, and not the next reading, not September's reading, but October, November, December, if we start to see inflation come down, then rates can take a deep breath. The Fed can take a deep breath. We will see October, November, December core inflation numbers coming down. And when core inflation numbers come down, the Fed can relax, interest rates can come down, everything will be okay, right? And I'm not saying that we're going to go from 7% to 4.5%. I'm just saying it's more likely that rates start backtracking than it is that rates go to 10%. We see that differently, eccentric, but that's okay. You see 10%. I see, Q1 of next year being G Glover. Okay. Yeah, to clarify, on your 25% down scenario, on your investment property purchase of 120, 6 points, about what it's going to cost to get you to 7.125. Each point is 1% of the loan amount. So if your loan amount's 90 grand, 6 points is $5,400. 1 point equals 1% of loan amount. So that's what that means, Mr. G Glover. I already forgot what I said, Norm. What's up, brother? Good to see you. Good old-time buddy of mine, fellow mortgage pro, Mr. Norm Bleskowski. I got to hit you up. You probably have some good jumbo products that I could refer over to you, and people are going to need your expertise. Why do you think we can't get rates in the 7s? We're only posting rates with points, and they're stuck in the high 6s with points. I don't know what I said or what this is referring to, but you let me know. Okay, eccentric. World War III now? I mean, I like a good conspiracy as much as anybody else, but I don't know. We ain't fighting with nobody, are we? Russia or China bombs the U.S. 60%. I mean, I think mortgages will tighten up for sure. If the economy starts going in the tank, unemployment spikes. That's what people don't understand about mortgage is 2010, 11, 12, prices were fantastic. You could find houses that were really inexpensive, especially when you look at the last 10 years of run up. Mortgages were hard to get, hard. And so to your point, right, like it's going to be more restrictive on the lending side should the economy get worse, which all signs point towards recession. All signs point towards this dramatic push higher in interest rates, tough on companies. You know, it's not just mortgage rates and real estate that's affected, right? It's the stock market and, you know, companies' ability to borrow money, companies' abilities to raise capital, all kinds of negative stuff comes out of the you know, Fed funds rate being raised. Necessary evil. And I think I agree with the Fed on that, right? Like we need it in order to combat inflation. Like that's their thing. It's like we got to do whatever's necessary to combat inflation. Gypsy Tree got approved for 5.45 in August. I mean, the lock and shop stuff is hard because you might have been able to lock something at a 5.99, pay up front for that, and have it for 90 days. If you don't find anything, you're subject to the current rates and you're out whatever upfront lock you paid. There was some stuff out there, and some new builders had some stuff that was funky in terms of lock and shop. It's still there. It's just lenders protect themselves, right? So lenders aren't just saying, oh yeah, lock in, find a property whenever you feel. And what we'll do is we'll lend you the money at 5.45, and then we'll just go lose money when we sell it off to Fannie and Freddie, the purchaser of the mortgage, after we write it, right? Like lenders won't do that. They will protect themselves. In a market like this, I would imagine they are going to charge you an arm and a leg, maybe a kidney, for those longer term rate locks. Those things have got to be super expensive. The better strategy, truthfully, is go out there and find a good deal, get the seller to finance a 3-2-1 buy down, a 2-1 buy down, a permanent rate buy down, whatever it is, but get the seller to fund that, because in some cases that might be one of the only ways they can sell their home. What about the competition with corporate landlords? They're all buying the lower houses and even building to rent. I mean, I think that corporate landlords realize that, like, we've got a supply issue. As much as people will say, like, there's not a lack of supply, there is, you know, on the rental side and on the available inventory to purchase side as well. And so, you know, Wall Street money and the corporate, you know, purchasers of real estate, they're going to either rent it or build it to rent. I don't know how much of an effect they're going to have on the market. Gypsy Tree, you can hit us up. Obviously, since you're working with us for your specific scenario, because I don't have it off of hand, like down payment, your credit score, and all that. But to get to the low fives may or may not be possible. A lot of stuff I'm looking at today, like max amount of seller credit that we can use and still pass QM, it's likely to be high fives. But nonetheless, let's look at it. And I mean, you want to have these conversations. You want to look at these numbers to figure out, like, okay, how is my agent going to structure the offer? How are we going to put together the offer so that it works for you, right? We want to be part of the dream. We don't want to be part of something that's stressful. Any insights on the Phoenix market? I'm not like super in tune with Phoenix specifically. What I will tell you is that if you had me guess, these hot markets like Phoenix, Sacramento, Boise, Idaho, Dallas, bunch of Florida markets that saw 28% one year, 22% the next year, just humongous price growth in 2020 and 2021. Those markets that rose the fastest are cooling the fastest. Sacramento being one of them. Sacramento, certain neighborhoods I follow really close. If you listed something for 550, late 21, early 22, flew off of the shelves, 30, 40, 50,000 above ask. Condition didn't matter. A lot of stuff didn't matter. That same house right now is price lower, concession, selling low fives. It might have sold for 580. Not necessarily like a 10% drop in price, but it appears so in some sub-markets, right? Where from the peak of where stuff was selling to where it is selling today, which is like, to me, probably a normal like year-on-year average of that price. That's my take on Phoenix. I would guess that Phoenix is the same. Like it saw a massive uptick, and so it's gonna cool off quicker, just because the frenzy stuff is gone. People aren't in a frenzy to buy with a 6 handle on their mortgage rate. Hey, what's up, Tim? You're going to want to assume the lease if you're buying. And if it's owned, then it shouldn't affect DTI, right? You just obviously get the owned solar with the purchase. But that lease payment will be factored into the debt to income ratio. I'm fairly certain on all programs it should be like that. Hit us up, team@mtmg.com. Oh, all these guidelines that just in my head at one time, and they just leak out slowly but surely as the team does more and more work on the pre-approvals and structuring files. Jose Negrete, thanks for joining, brother. Now that we are so close to 7, do you see 8 by the end of the year? We could, but I mean, it's like the wind blows and rates move, right? Like today, rates got drastically worse, and it had to do with stuff going on in the UK. I couldn't have predicted that. The lease payment doesn't get factored in on the solar, maybe because they save. See, that's why you got a mortgage pro like Norm here in the comments. I take that back, Tim. I don't think we factor in that payment. I was unsure, so I went with conservative. Truth be told, I've got team of experts who are underwriting experts, underwriting every single file. So rest assured, you get pre-approved with my team, you are dialed in. 5 years ago, when I'm handling every pre-approval personally, I'm fine-tooth comb on that bad boy. Right now, teams handle it. They're good. You want me for the structure, for the numbers, for putting together a game plan for seller credits and purchase price and how to negotiate with the seller. I will coach your agent up like crazy. This is a popular question nowadays. Thanks for bringing this one up, Lindsay. Can I assume a mortgage has a lower percentage rate? You can, but conventional loans aren't assumable. Government loans are. You've still got to qualify. And the problem becomes, like I saw a question on a VA loan where it's like, hey, can I assume this? Well, if you assume a VA loan where somebody owes $325 and they're selling you the house for $625, do you have that $300,000 to put down? That's where most people are going to run into a problem. And I would guess if you're assuming a FHA loan from somebody, they bought with 3.5% down FHA, they're looking to sell this house, take their equity and go purchase forward. They're going to need that equity, right? So you're going to have to come to the closing table with a lot more. FHA loan may or may not be the best for you. So as much as it sounds great on paper, it's really like in actuality, not something that's happening as much as you would think. Pros, cons. Will rates come back to 4% next year? I don't think so. I think that rates can certainly come down when inflation gets under control, but back to 4%, I don't know. I guess they could, right? I don't think that it's going to be a dramatic return. It'll be a wild, wild mortgage market if the next 6 months, 5.5, 6.5 mortgages get written, and then we go down to 4 by the end of next year. It will be another refinance frenzy. And you guys know who to call. You guys better hit your boy up if rates go down to 4%. And I make it really easy. All you got to do is go to greatmortgagebroker.com. You fill out the form. I promise you the team is in touch within 24 hours. I've gotten great feedback on that. It's like 5 or 6 questions: name, email, phone number, where you're at, what you're looking to do. We won't harass you, but if you're looking to get help, you're looking to get pre-approved, you're looking to run from refinance scenarios, not a lot of those. We got you. All right. What's the best areas outside of Sacramento with more land? Half an acre to an acre, homesteading type property, 600 to 750. There's a lot of these. And you know what? I would say send us a specific message, because I would connect you with certain realtors. There's a lot of these more rural areas with land. What you have to take into consideration is in California, in these areas that are more apt to fires, you're going to have a really big homeowners insurance policy. They've got something called the California Fair Plan. And whenever anyone is like, hey, I'm going to buy out here, I'm going to buy in Auburn or a lot of these areas, there's lots of them. 4,000, 4,500 between the normal policy and the California Fair Plan. They do this wrap deal where they wrap the two policies together. That is going to be something you want to consider, right? Because you can get housing that's a lot more affordable, but then you're going to have to take into consideration that big old homeowners insurance. So hit us up directly, Gypsy Tree. I don't know what your real name is, but if you say we got you pre-approved, I believe you. Todd Bazalski, what's your take on home values in 55 plus communities? Any different than standard areas, and in particular in Florida? While I've done quite a bit of business in Florida, we haven't done, I don't think, anything in 55 plus communities. It's wild to think is I'll be 55 in 13 years. I know I don't look at 42 years old, besides the wrinkles and all the dating that mortgage has done to my wrinkles. Yeah, I don't know much about the 55 plus. I wouldn't want to comment on that. Yeah, I believe you to a certain extent. Pros, cons. Prices do have to come down if rates stay high. All right, what else we got? We're coming up on an hour. Rates are at a 20-year high. I saw that today. I think that article came out like 2 hours ago. Forever, it's like 14-year high, 14-year high. We kept testing this 14-year high, from 2008. Now we're talking 20-year high. Holy moly. Quoting top tier 30-year fixed rate over 7%. And like I said earlier, the 10 years up in the 3.9s, 3.92 or something. Last I checked. Multiple Fed speakers today reiterating that, nothing's going to change or continue to pump rates up until there's clear signs that inflation has turned a corner, which I think they like. I don't know. I don't want to get too much into minutia, but so many things are looked at year over year, and year over year is just a tricky thing. I think home prices are one of those things. When you look at Redfin or somebody else saying home prices are up 7.5% year over year. Yeah, but in the shorter run, even though I know historically in this period, in this season, home prices come down. If they're coming down a little bit more than normal, it's something to watch. Trope force. While I've heard of this, we don't do a lot of this, so I wouldn't be the best one to talk to about tenancy in common. I think that there's actually some stuff in the Bay Area that has this type of lingo verbiage in it, but personal experience, I don't want to steer you wrong. I'm not the guy for that. I'd love to hear from anybody who's out there currently in the market, shopping, offering. What are you seeing? I know my clients, and even an offer that the wife and I were going to write, we've got the list side reaching out to us. I know agents who are hearing from the list side agent saying, hey, your buyers came through here last week. Any interest? And the next week it's like, oh, hey, just touching base. If your client's right, my sellers are really motivated. They will entertain any offer. I mean, that's the kind of stuff that's coming out of the sell side nowadays. The builders as well are courting real estate agents again. Funny how the tide turns. That's good, Carrie. Yeah, these builders generally offer these longer locks because they're taking 10 months, until build completion. So hopefully they're done by next February, and then you don't get charged any extensions. You're in a good spot at that 4.75. And so make sure that they complete that dang thing so you can lock in there. Pay 1%, which, not a big deal. That 4.75 rate is just out of reach. Nobody can get that today. Oh yeah. See, rates were close to 4% and you paid the premium, which in retrospect was perfect, right? Somebody sees that today and they're like, oh, they pay the premium, if rates are 6.75 and they lock into a 7.5 with a 1 point cost. If rates come down to 6.5, they're kind of effed, right? They paid that point up front. So I guess hindsight's always 2020. Genius idea in February. Probably not that great of an idea right now. But nonetheless, you're in a good spot. You're in a good spot with that. What else we got going on in real estate? Just all this talk about what's going to happen in real estate. I can tell you one thing you can certainly count on. There's going to be more opportunity for buyers. Sellers are going to be more desperate because buyers are, really in short supply. Buyers are. Even the buyers that are out there are going to hesitate on pulling the trigger at higher interest rates. Luckily, we've got really cool stuff we can do. Buy the interest rate down, take seller credits and do that. Not all buyers even really know how to do that or that's available. So I think if I'm a buyer in today's market, keep your eyes and ears open. Here's some good intake. 10-year yield almost at 4%. True story. That's verified. Where the heck did my screen go? 3.928. Debt market ready to implode. Rates should be at 9% by year end. Whatever they're listing, offer 30% less. Don't dream rates will not come down until 2024. Sitting on money. Well, that's one viewpoint. I think that, you're not necessarily going to get a lot of bites offering 30% below list price. You're going to get buyer or sellers that negotiate. I mean, I saw something that was 925, and those buyers are probably going to consider something in the high sevens, 780, 785 for a client of mine who was patient enough to say, I'm not paying 9.25. They almost wrote in the low eights, sat on the market for another couple weeks. Seller came down to 900, then 850, then 800. And when you have 3 price reductions, 125 grand, that seller's motivated. So the buyer is going to strategically come in below that 800, knowing the seller's got to sell. And that's what you're going to find in the market in the next 6 to 12 months. Sellers that need to sell, and they have more urgency than the buyers. The buyers, some of them have urgency because they don't want rates to go even higher. If you're on the brink of qualifying, buying the rate down to 5.99, you might not be in a position where you can wait 2 months. If rates go up a full percent, you might just be out. But anyhow, I appreciate the conversations. I appreciate all you that joined. We got up to about 90 folks on the live. Ping me and the team. Let me know how we can help. Happy to, go over scenarios, get you pre-approved, get you in a position where you can make these offers, because I know a lot of investors, and I know a lot of people that are primed and ready to go out there and find real estate deals, even at 5.99, 6.99, 7.99. Real estate, is a beautiful asset because of the leverage. And there's gonna be deals to have. Okay, do you know of any closing cost grant in California that's not income contingent? I've got a nationwide program. It's pretty gnarly on interest rate, but feel free to reach out to us, Mariha. It's Empower DPA. Our friends over at EPM, based out of Georgia, have a down payment assistance program that's going to cover down payment. And I would say, you don't need a closing cost grant in this market. You go out there and get a seller credit. Let the seller be your grant, right? Some of these down payment assistance programs are going to come at a cost. You're going to pay a higher interest rate, or there's going to be costs involved with that program, where you get $10,000 in seller credit to pay off your closing costs. That's a grant for all intents and purposes. That's free money. I would do it that way. So reach out to us, team@mtmg.com. If you're in California, we will be happy to review your scenario, because jumping straight to down payment assistance isn't always the best bet for you, depending on what available funds you have. If you need down payment assistance for the down payment and the closing costs, then that EPM program might be the one. But there's a lot of different things to consider on what's the best for you. I just offered a lower price in Sacramento, 4-bed, 2-bath with a heated pool, listed for $565. I offered $535. They countered $540. Is this a good deal? This is contingent on a lot of things. And I would say team@mtmg.com. Feel free to shoot us a message. The area, how long it's been on the market, all those things come into play. Depending on whether it's a multiple counter, whether it's going to you and others or just you, how bad you want to be in this neighborhood. As much as buyers have leverage, like there's not unlimited leverage where there's no other buyer if you don't want to buy this house. And so some will be like, offer less. I get it, right? Offer less at 520. It's multiple sellers or multiple counter and somebody else buys it for 540. And then you maybe go find that similar house for 520 2 months from now, but rates are 1% higher and your payment's $200 more per month. That's not necessarily a good game plan either. So team@mtmg.com, shoot us a message. I'll be happy to review it. You've already got a realtor in place. You've already got a lender in place. I'm not going to mess with that. Just give you my 2 cents. Flash of light. I'm not selling my house, sit on my 2.25 mortgage. I got lots of them. And, to Eccentric's point, that's an asset holding on to that low interest rate mortgage. So that's what I'm going to do. All right. That's all for today. I appreciate each and every one of you. Thanks for joining. Each Monday at 3 p.m. Pacific Standard Time, I'm here. Happy to help. If you're looking to get pre-approved, that's greatmortgagebroker.com. If you're looking to connect with an agent in your area, that is homeandmoney.com/Matt. If you want to talk to the team and you're local to us in Sacramento and you want some advice, we're happy to help. Team@mtmg.com. Thanks for watching. Till next time, we gonna see.